And we are live. Welcome, everyone. Bacon, it's been a minute.
Yes, it has.
How have you been? How's your life? How are
Uh,
things?
Hectic. It's here. Anyways, how have you been? How have you been, good sir?
Good. Getting ready. I think got a baby coming here soon, so just getting ready for that. Other than that, just kind of work. Got two simultaneous audits going on, so that's fun. Um, just finished actually like a payroll tax audit and something else, and now we're doing actual financial audits. It was a workers' comp and a payroll tax audit we just finished up,
Heavy lies
and
the crown.
heavy. And so now, um, going through two financial audits, and in my spare time, looking at short reports. And I want to be clear: I am not short this company. I am not long this company. I found this short report interesting, and so, I think it's interesting because it's a lot of accounting um, accusations from the short seller, or the short seller. And so I thought it'd be a good one for Bacon and I to kind of review, look at, and talk about. So I will share my screen and we'll hop right into it. Actually, no, I'll share on this side. Can I pull you out, move everything over there? We're gonna do that. Boom. Okay, where is it? Okay, here we go. So this company officially has, I think, one of the funniest names, Jehoshaphat Research, which
Alrighty.
is after King Jehoshaphat, I think, of Babylon, I assume. So they are short Montrose Environmental Group. Montrose Environmental Group, they're a scientific kind of consulting firm. Um, they have an emergency response segment, so they help with, and this isn't like the kind of ESG. I think that's like BS. It's like making sure you're up to code on your different like regulations within cities and states, and they have an entire thing in their investor pres I can go to.
Yeah, yeah.
Let's see it here. Investor pres. And as always, Tilly is here too, scratching because she put the ball down. Good girl. Okay. So this is like their solution. So assessment, permitting and response, measurement and analysis, remediation and reuse. So like assessments of land. So like, for example, I have a friend who owns a business and there was accusations that they were dumping chemicals on their land that are environmentally that are very, very bad, like truly bad environmentally. So they would have to hire someone to go out and actually a third party, an independent third party, to go out and test it. I think the city was trying to. I think they just wanted them to pay money. I think it was just like a cash grab by the city.
Oof.
Eh, Obviously, they would do something like this. You go out, you test it, and then you say, okay. They came back, tested, and said, yeah, there's nothing here. But you go back, test it, and say, okay, then you could consult and say, here's how you fix it, or here's so you're going to go buy a land. You might do this. There's a lot of uses for it. I'll be completely transparent in saying I'm not super. I am not an expert in this.
Mhm.
What I like to do though is look at the accounting because for the short report, it's primarily accounting focused, and so we can talk through that and say, okay, what what are the accusations? How does that lamp to our thoughts, and go through it. So Jehoshaphat Research is short Montrose Environmental Group, MEG. So they go through all their legal disclaimers here and they give kind of a quick overview. Here's their thing. The company has observed a decline in organic revenues. They've pulled forward revenues by surging contract and other assets, day sales outstanding, etc. So I guess we'll stop and just take a quick, for those that don't know, days sales outstanding. And we've talked about this before, I think with cons it was. Maybe we talked about cash conversion. I don't know if we talked about DSO. Days sales outstanding, it's an accounts receivable metric. Do you want to quickly explain what DSO is, Bacon?
Uh, Basically, it's one of the methods, as you said, of cash conversion. So, from
Right.
the accounting perspective of revenues, or sales, when is it supposed to be or generally listed as a sale? Well, when performance obligations are met. Thing is that doesn't necessarily do anything for the actual entrepreneur or business operator. Business operator definitely cares about, okay, I have a sale, I've met the obligation, or I'm in the process of meeting the obligation. When does it turn into cash?
Right.
Two very different
So
things, and DSO take
right.
focus on that.
And I'd say the simplest way to measure DSO is saying how long has my AR been outstanding. That's
Mhm.
essentially what you're looking at, is how long on average is your sales. Like, and this is a very common metric. I use it at my company, my organization. We use it and we say, okay, how long is it taking for people to collect from people? You know, typically you want it somewhere between 30 and 45. It really depends on the business that you're in, which is something that we'll get into later. Um, they're saying adjusted EBITDA is inflated by approximately 80%, making peer-based multiple analysis useless. Their roll-up strategy is chaotic, has failed. There's no underlying free cash flow, and much more financial leverage than it appears to have. Okay. So this is them saying they measure the organic growth of this company as negative, basically. If you look here, so this company does have a lot of acquisitions. We saw that,
Mhm.
and um,
Yep.
Fuhet's
Oh,
I can't
whoops.
shit.
There we
Yeah,
go. Yeah.
Fuhet's all mad at me for trimming KKR by like 2%. I'm still like massively invested in KKR. He's like, oh, we killed it. So
Good old Fruat.
shout out.
Yeah.
So they're saying that this company does have a lot of acquisitions, a lot of roll-ups, and that there's actually no true organic revenue growth. And there you hear the beep or the squeak from the dog.
No, new squeaky toy.
Yeah, she broke the old one. So she chewed on it so much. She's got like this one. It was like a popcorn. It was from BarkBox, and she chewed on it so much, and then she would just sit there and like eat at it. That eventually the squeaky toy came out, and then like she actually just like completely tore up the toy, and so now she's got a new one. It's a phone. So I don't know. Maybe she's calling a boyfriend or something. I don't know. And then we were talking about her, so now she's leaving the room. Anyways, so they're saying negative organic growth. Okay, so let's go
Yes.
down. So here is where they say they've changed the definition of what organic growth is. And what I do find interesting is what lines up with this. And I went and I looked, and you can see here I have the different 10Ks.
Mhm.
Is after they acquired CTEH, this company here, which was right here in April 2020. After this, they voiced a cooling opinion, but then they got a critical audit matter related to revenue rec.
Yes.
So revenue recognition is an extremely common critical audit matter. To be fair, I'm sure you see it all the time. I see it all the time. The last company I worked at before this organization had a revenue rec critical audit matter. It might have actually been deficiency, but I think it was a critical audit matter from the auditors. That was before we went public. I don't know. They're public now. I'm no longer with them. I don't know if they still have that. But very common.
Thank you.
So with the CTEH, it says here they're a scientific consulting firm that specializes in emergency preparedness, response, and recovery. So when it's saying emergency preparedness, it's talking environmental emergency. I would imagine, I could be wrong, I haven't dug into this enough, that this is particularly going to be working with governments. And when you work with governmental entities, there's a lot more time. It takes, by definition, it will take you longer to get paid. At a minimum, you're going to have a 90. So most companies, you send an invoice, it's a net 30.
Yep.
Government, they're gonna say no. We're gonna pay you net 90. It's just how they are.
Yep.
You don't have a choice. I actually have a story. So my COO used to be an auditor, like back when he started his career, and there was a company in a larger city near us. They were an energy company, oil and gas, I believe. Maybe it was a refinery, I think, and they got a government contract, massive government contract. They were stoked about it. And then they went bankrupt because they couldn't manage working capital because they weren't
Oh
prepared for the expansion in DSO. Yeah.
no.
And so then I think they like got super in trouble, and then someone else bought them out, maybe who had more
Yeah.
capital, who could manage it. But I remember him telling me that story specifically about government entities. So you have to be ready to. It kind of makes sense that DSO would be expanding. Now, they acquired this company in 2020. I don't know if they've made and we can go through their list of acquisitions maybe
Mhm.
to see if they've acquired other companies recently and made big acquisitions. I think they made one or two big acquisitions to see if those are more government based, and that could help explain why DSO is rising, or if this company is growing at a faster rate. Who knows? Okay, so we'll go back to this. So basically, it goes through here, and it see all the CTEH, 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 and I didn't think there was a ton of changes in here that were like super crazy, but like it does change a decent bit. I don't know. I'd have to look at other companies. I don't normally pay that close attention to what a company does or doesn't define as organic revenue. And like the changes year over year in the 10K, maybe I should. So it's something, but I have to dive more into this to see if that's really that big of a red flag.
Mm.
Okay. They claim they retroactively changed numbers. I'm not going to go through and really worry too much about that. Yes, Ryan Dangler's asking, is it true Dan has been arrested for loitering at McDonald's? Actually, he got arrested because he kept on asking them for more chicken nuggies after he wanted refills on them, and they wouldn't give it to him. He started arresting the employees and said, I am a shareholder. I own you. And they were like, sir, no, you don't. Leave, please. And he
All
refused.
all jokes. Dan knows very well enough that it's a franchise model, so he wouldn't do that type of thing, even for the memes.
Yes. So then we move down to Dan got arrested for not getting his McFlurry. Dude, their McFlurry machines are never up. So Dan should be used to that by now.
That's crazy because like the ice cream machine, well,
Which is the ice cream machine that's never
yeah,
up.
yeah, like they for like the McDonald's near me, like it's always up and running, which
Oh, really?
kind of shocking. Yeah, pleasantly shocking. I guess corporate was like, we're tired of this meme, we're clamping down some, but
So
yeah.
this is one thing I think is interesting. They're saying
Mhm.
earnings quality is atrocious.
Yeah.
So earnings quality is basically you look at a metric of things. So you look at there's a bunch of different factors that you put in. So you look at like, okay, I have net income of 60 million. How much of that actually converts to free cash flow? How much of that is concentrated in one customer? How much of that is recurring? Like there's a bunch of different things that you look at to say how good is the earnings quality. And they're saying here it's trash, which I find relatively interesting because we'll get to this later.
Yep.
So that they have this here. It says last 12 months free cash flow, excluding XBC, stock-based compensation, adding back payments for earnouts.
Mhm.
Adding back payments for earnouts. So they're not subtracting. Okay.
Yep.
And aircraft purchase.
I love that. That's just like sitting there. That the
Did they
aircraft
buy a
loan,
big aircraft? I'm wondering why this is so.
the aircraft is in fact there. Yeah, for in the 10K. It's like, okay, that's material enough.
Wait, let me see.
That's
How
funny.
big is this?
I don't think it's like that much of a deal breaker, but you know, it's there. It's there. Uh,
Let me see. Aircraft.
yeah, aircraft loan.
I mean, I guess they use it to transport people.
I mean, yeah. Well, I mean, at least they talk about the aircraft rather than as a certain RCI hospitality.
Yeah, 10.3 million.
Yeah, thereabouts.
Wow. Okay. So back, close that out. So let's look at their free cash flow and compare it to this. And also, one of the things I'm just going to pull up, because this is one of the things they're saying earnings quality is atrocious. That's assuming that they've had earnings, which I feel like they've had a net loss pretty well, at least in the first 6 months. I don't know if they're back. This is like we said, this is relatively early on us looking at it. So if we look at financials, okay, here's net income. Okay, haven't had positive net income.
Nope.
So
It's in a cruel, cruel world we live in, Andrew. I bet you never heard that joke before. It's an accounting joke, everyone.
I just don't get why they're pointing to this when it looks like, I mean, net income has been negative. And I look at, and we can look at this quarterly because that's what they're doing.
Mm.
So we'll compare it to free cash flow. You know, because it's CFO, just to see.
And full and fair disclosure, everybody, like this, Andrew and I have done like varying amounts of like early stages due diligence on this, where I've only listened to one earnings call and only just once.
So it is true that they've had a lot of SBC.
Yes.
So so this is not accounting for SBC. Okay. So now let's look at the free cash flow. Can I do both? Let's do
maybe you got a
I'm just
shot.
gonna do CFO and then I'm also gonna do free cash flow.
Mm-hmm. Hey, there you go. So bottom line free cash flow is green and CFO is white.
Yeah. So I'm assuming they had a lot of, well, they had negative cash from ops here too.
Mm-hmm.
I wonder what happened here, why it was down so much. I mean, it kind of explains, you can kind of see why the company sold off. Look, positive cash flow, positive, boom, to negative cash flows. What's happened to the stock year to date? It's down 30% in a SPY that's been up 30, or yeah, up 20. I'm sorry. And if you look, I mean, so what's going on here? Obviously, like we said, cash flow issues. But was that just a 1 quarter thing and now they're returning back? Because now cash from operations is positive. And like we said, we'll get into all this. So they're saying they are taking, they're not adding back SBC, right? This is saying X SBC.
Yeah, it seems like
That seems kind of, wait, X SBC, because I feel like that's redundant. Why are you talking about free cash flow and then saying X stock-based comp? Because that's not a factor in free cash flow.
Mm.
Okay. How much is the preferred dividends? It's like 4 to 5 million a quarter.
I want to say so, if I recall correctly.
Yeah, so it's like 4 to 5 million a quarter. Okay, so that's fair to back that out. No, it's
16.4 in thousands.
So I guess that's fine to back that up. Fair enough. I mean, because you're talking about for common stock. Okay. But in a lot of quarters, this was fine. Okay. So let's look at then. The only thing I'm seeing here is them taking out preferred dividends. Like they're getting a negative for the last quarter. Negative 80 million free cash flow. like we can pull up their actual 10Q here in a second, but I'm trying to see. That's a lot. You're going from -11 to -80. They have to be adding back SBC. Let me just read through this again because it's far. After making proper adjustments, is far below its optical free cash flow, CFFO minus CapEx, which looks is -79 million over the past. Oh, this is LTM. Oh, I'm an idiot. They're doing LTM. Oh, okay.
Yay,
My
LTM.
bad. My bad, guys. I am sorry.
This is why we can't have nice things.
Okay, now let's do it. So we're going to do LTM. And I just want to see cash from ops as well. And then we want income statement.
Net income?
Yeah, net income. Okay. So they're saying free cash flow is -80 million LTM instead of -16 million. So to be fair, if you add in the preferred dividends then, okay. I'm starting to, that would probably be a lot larger on this. So we're talking, okay. So there you bridge it to like 30 million, right? Almost on the dot of negative free cash flow. The aircraft loan, which I feel like isn't, it's a $10 million loan. I can't imagine it's like that big of a deal. I'm almost like, don't want to worry about that.
No.
Adding back payments for earnouts. I'm not even going to worry about that. So, okay, see end note for detailed explanation, just a free cash flow calculation. So what I'm going to do is duplicate this and go to the end note and see how they calculate this. I'm assuming this is like all the way to the bottom. They said 6. We start with the traditional definition of cash flows from operations, less tangible and intangible CapEx. We then subtract stock-based. So they are, it says subtract stock-based compensation. So they are taking the SBC. That's where it's all coming from then. Because what's SBC on it? Yeah, I mean, that's the number. That, you know, they make it sound so complicated. Free cash flow, -16. Add back preferred dividends. There you get 30. You add the SBC, you get 76. Okay. I don't know why you're talking about SBC, though, in free cash flow. Like, I get it, but... Okay. Who are their competitors that they compare them to? TT. Okay, let's look at these guys in comparison. I'm just going to assume these are the guys. So let's look, we'll do one at a time.
Yeah, that it's a reasonable comparison.
Yeah, I mean, yeah, TTEK. We'll just, I mean, these guys don't seem like ill intent or anything, so I'm just going to assume. It's probably going to take a minute because it's trying to pull up like all the bar charts, all that together.
Andrew's internet is trying its best.
Okay, so these guys are a lot bigger, I'm assuming.
Yeah. Market cap of, survey says
12 billion. And what is MEG?
Under $1 billion, like I want to say 700 and change.
700 million. So, yeah, so we're talking 15 times the size, más o menos.
Yeah.
Okay, that's fine.
I remember.
So, okay, I'm going to pull out. So we've already looked at MEG, and so we know what's going on there. So I'm actually going to pull MEG out. And we're just going to do this for TT. Can I just do hide? There we go. Hide MEG data. Okay. To be fair, the SBC here is a lot lower. Like, it's lower numerically, and then if you look at it as percentage of market cap, that is high. Yeah. Okay, so then let's look at ACM. Now, to be fair, they're a smaller company. They're not as free cash flow positive and can't just like pay in cash. So you could make that argument. But Fair point. Yeah, I think it's mostly my PC. That's the holdup on this. Not the okay. So let's pull out TTEK. And ACM, I think, is the big two. It looks like 13 billion.
Yeah. Bigger boy.
Yeah.
Yep.
But look at this. So look how their SBC goes down over the years as they become bigger market cap. Like on it's hard for me because I have to like go up. On just a numerical basis, it goes down. And so, and that's a fairly common thing. You're a smaller company. So, like, fair enough. If you're saying, like, they're not as high quality, they're stuffing more SBC than these other guys. Okay, fair enough. And you could also argue, well, they're not having the growth to, let me go to this. Let me go to estimates for them and compare growth estimates. Like, you could argue they don't have the underlying growth to justify that.
Yeah.
I mean, these guys are being, I mean, you're looking at, why can't you just compare them all together? Come on. Okay, so you got like, come on. Why aren't you showing? Okay. Oh, they have different fiscal years. That's why.
Yep.
So you're getting 10% versus 6 and 4%. I mean, that's okay. So you're getting 13% versus like 3. So it does look like they are growing a decent bit more. Okay. Anyways, the point is, I do think it's a little odd to be comparing. Maybe not. So okay. So going back to this, I don't know. It depends on how you feel. If you think that like they shouldn't, I mean, I agree that maybe potentially this much dilution isn't good. Now there's an item on the dilution that we can talk about at some point that makes it difficult to know how much they're actually diluting that we should probably look at.
Yes.
I guess we can jump to that right now because that's
we might as well.
So here, okay, I'm gonna duplicate this because that's another thing, which is adjusted EBITDA. So one of the things they have, and I'm trying to figure out how much of the SBC actually is this. So, and I don't know if it's any. So it says the following common stock equivalents were excluded from calculation. Stock-based plans and compensation. So, employee equity incentive plans. The company has 2 plans. So, what they're talking about here is the 2 different plans they have. It's very common. You have a 2013 plan. You have a 2017 plan. Okay, cool. And here's shares authorized to grant, shares available to grant, whatever. So one of the things I noticed is that the shares available to grant have gone up a lot. Now, one of the things is within their dilution or within their 2017 plan, they have these stock appreciation rights. Stock appreciation rights are 3 million units. They only get redeemed, 1 million tranche at 133 a share, 1 million tranche at 166 a share, 1 million tranche at $200 a share. If you're looking at a $20 share price company, these don't matter. You don't care if the company gets diluted at 133 a share. You're happy. Like that's a champagne problem that I have to deal with. Now, what I was trying to work through is figure out how much is any of the SBC related to this in any way. I don't know if it actually is.
I want to say based off the most recent 10K, it seemed like it was a previous year thing that they just like were like, yeah, this is going to SG&A, which naturally, given who usually tends to get SBC, and that would seem to be the case. The only nuance though is if we're talking, stock options,
Right.
yeah, like people, will hear stock options and ears will perk, and they'll be like, oh, like what my Robinhood app says, or whatever brokerage app says, like options chain, we can do this, and not so fast. How companies value those models matters, and that is a
Right.
topic that is far above my head. Like, I'm
So
aware that black controls exist, but
so I would say, for the purpose of your value in this company, I think that SBC is real.
yeah.
Like, I don't think this is like a SAR thing that's not going to get hit. I think that SAR's already been included,
Mhm.
and that's real SBC.
Yeah.
That's what I'm operating out of. I'd have to do a little more research. That's how it seems to me.
Yeah, because as it was written, it was like a 10-year expiration time period,
Hmm.
and it seems like they have roughly 7.5 ish, give or
Hmm.
take. Cut me a lot of wiggle room here on the decimal for the expiration.
Yeah, I mean they have like a 500,000, it's a 500 or 500 million
Hmm.
conversion option.
Hmm.
No, 500,000, right? Because they have 60 million cash. Yeah, 500,000,
Yeah,
which is like whatever. Conversion option that might be related to that, but I wouldn't really. I mean, to me, it's de minimis almost.
yeah,
Um, they have some debt. It's not that bad. Although I want to see them talk about them being more indebted than they actually seem.
yeah.
Okay, here's where this becomes very interesting. Net unbilled DSOs are up 68% over 2 years.
1% off the magical number, chat. Nice.
So so they're saying separately or regular DSOs are up 25% over 2 years. So they're using the Q2 2024 numbers. So let's do this. I'm just going to do some like BS Excel so we can actually look at this. Because I want to look at regular and then we can look at the net unbilled.
Hmm.
Uh,
Welcome to Two Accountants, One Gap. It wouldn't be an episode if we did not share a single spreadsheet.
okay. So let's do this. I'm going to take numbers from here, put them on a spreadsheet, and then we'll go through the spreadsheet. Because what I
Yeah.
want to see is we want to look at the quarterly numbers and compare them because I have noticed it jumped up a lot. And I want to say they're saying 25% in 2 years, but that's all been last year. Which is interesting if that's the case. Okay, so here's accounts receivable. Okay, so we got 1335. Okay, so AR as or I'm going to say date AR amount. This is like super simple stuff. Okay,
Mhm.
and then this is off screen, but I'm just okay.
Yeah.
And we'll include contract assets as well because that's going to be relevant later. Okay, and then what we'll do is I'll go and pull. I'm just going to get rid of that one. 2023 Q2. Okay. $103,720, and then we have 574. Okay, and then okay, so then we have AR amount E766. Okay. Oh, I forgot I have to do one thing really quickly because I also want to pull their revenues for that year. Do I do 6? Yeah, 6 months should give me the same too. So, oops, we'll do this over here. Okay, 2023. Just bear with me as I do this.
Mhm.
Basically, what I'm trying to do is say, what is these items as a percent of revenue, as well as, Because if your AR goes up 25%, but your revenue, and I know the revenue didn't go up 25%, but your revenue goes up 25%, it's like, well, okay, so then we want to do, actually, let me do this. Okay, so now let's move this over here because we can look at this. Okay, so equals should work, right?
Yep.
Yeah. Doesn't matter. Okay. What?
Thank you, President. I made a dumb joke saying if I were an accountant right now, I'd be an accountant who can't count. Yeah. So.
I think those numbers are right. Okay.
Yeah.
Let me go. Okay. So it does look like the AR is growing quite a bit year over year.
Mm-hmm.
Total change, you're looking at 19 and 30%. You're seeing a revenue change of 13.1 and 5.8, which means there is an outsized growth in your AR over your revenue. So they are saying now, I just want to see what they define as contract assets plus net AR minus contract liabilities. Oh, because they're just measuring the DSO. Okay.
Mm-hmm.
So let's understand these guys have a lot of government revenue. One of the things that I was wondering is, have they been making acquisitions and going more heavy into government revs? So one of the things, I don't know. Let's see. Okay, so they're not showing. I want to say this is like the most recent. Okay, so maybe they don't break it out. I mean, maybe it's not as easy as searching government. Well, a lot more talk about governments than this. Did I misspell government or something in the last one? Why is it? Oh, was the last one a 10Q? Ah, that's why.
Yeah,
Okay.
yeah. I was gonna say I'm looking through the 10K right now on acquisitions.
Okay.
Okay, this is in thousands. I want to say. I'm gonna assume so. Price, yeah. So 2023 acquisitions far exceeded in total. 2022.
Our financial skills do.
Yeah, far exceeded. Total purchase price. What about 2021? 1, 2.
So one of the things we can probably do is let's do it this way because we don't want to just sit here looking at this.
Yeah, 2021 was quite extensive.
So if you let's look at the investor pres here from September, because I think they break out the 2023 revenue segments, saying, and I think government in 2023 was 11%, which isn't a lot.
No.
Yep, government right here. Boom. Okay, 11%. That's 2023. Can we find one that talks about 2022, and then we can go through there? Okay, so archive presentations. Let's look at this. Let's see if they have it in here. Revenue and market mix 2022. Ooh, Fed, state, local governments, the same percentage.
Yeah.
I don't know about that. Okay, and let's look at 2022. Just be
Completionists.
Mm-hmm. No, they had way more.
Yeah. Okay, so they did, at least as of that date.
Oh, is this excluding? So this one says excluding CTEH.
Oh, okay. Yeah.
This one is not. I would, but this one's not, unless they're also excluding CTEH here, but they're not saying it. I would think CTEH would have them increase
You would think, but maybe that isn't the case.
because
Benefit
they're
of the
like
doubt.
emergency response. But yeah.
Yeah.
No, right here it says 90-10%, 10 split between private and public clients. So I guess
Yeah.
maybe CTH brought it down to 10%. Either way, it hasn't grown that much. Let's look at the earnings call. I just want to see if on the earnings call, if they break it out in the most recent one.
That I don't recall. Sadly, I only gave this earnings call a once over.
First half revenues increased 13.1 point. Foreign earnings growth in both periods were strong. Organic revenue growth in our AP&R and M&A segments, and the contributions of acquisitions partially offset by lower environmental emergency response and water treatment revenues. Looking at our consolidated just EBITDA performance, slide 11. Okay, moving to a review of adjusted net income. We report diluted assessment per main response segment. Second quarter revenue was 53 million compared to 61. It's solid organic growth. It was more than offset by 14 AP&R, just EBITDA, in our measurement analysis, remediation reuse. Then 12% organic. I mean, shifting gears in a Washington business is lower in the second quarter. Blah, blah, blah. So, okay. So I'm going to throw out that it was additional government. I think you really need to. I don't see them having grown their government. Like, there's some. You would really want to talk to IR and see why, if they say why AR is ballooning like this. Because it is ballooning quite a bit over revenue. And as we saw, DSOs increasing, day sales outstanding. But I was thinking maybe it's a government project, but it doesn't look like government as a percent of their sales is growing. Like, very slightly. So I'm wondering what's causing that. So if I was going to go short or long, I'd try to see what the response is from management on that. Like, why is your AR increasing? What's the reason? Because for me, my thought was government, but doesn't seem that unless I'm missing something, because they're saying here, unless there's something within these that's government funded, but I feel like they would break that out here or here, where basically, Fed, state, local government ties exactly to this. So I think that's a fair point by them potentially. It's like, now I don't know if they try to reach out to IR, if they've talked to, CEO or management and what they said. And then they say that they're the only ones having this happen compared to their peers. Let's see what they say. They say here's what management said. Blames an acquisition from a year ago for current invoicing delays, and those supposed delays appear to be a size what would dwarf the acquisition's revenue level. You've also pointed to new projects to explain what seems to be an increase in invoice but unpaid billings that's been going on for years. Yeah, so then they're saying they're not increasing their allowance for doubtful accounts.
That's what they said. They being the short sellers, but the financial statements, at least on the 10K basis, it seems like it's been ebbing and flowing as far as at least allowance for doubtful accounts.
Oh, really?
Yeah, let me take a look at bad debt expense. See if that changes anything on the picture.
I'll also be curious. While you do that, I'm going to pull up the 10Q and see what bad debt expense was year to date.
Yeah. Yeah, 3.1 mil for the most recent 10K. 3.1. 2021, it was 1.1. And 2022, they had a bad debt recovery
Interesting.
of 1.1. That is interesting.
Oh, I see it here. Yeah, bad debt expense recovery. So they're saying they had a bad debt recovery of 659 million so far this year.
Yeah.
Yeah, that's weird.
Do you think they might be doing anything a little fishy there with the allowances and the recoveries? Now, of course, like for the viewer, we're just people, very early stages, banging rocks together.
Okay,
Yeah.
So curious on the 10K. Actually, go to the 2020 the 10K for the year ended 2022. So the 2023 10K.
Oh, okay.
Can you see if they had a customer that exceeded 10% of its gross receivables? If they had one customer?
Actually, I don't think I'll still do that.
No, actually, look at this. Company had 1 and 0 customer that exceeded 10% of gross receivables as of June 30, 2024 and December 31, 2023.
Yeah.
So what they're saying is someone's coming in with a lot of AR. Who it is, I don't know.
Yeah.
Is that the explanation for all this AR buildup? Would it be flat? But then you have one person that's just billing a lot, who has a longer billing cycle, who has something? I don't know. Seems kind of just a question to ask. I don't know.
Yeah.
Interesting. So they weren't over 10% as of December 31, 2023, and then now they are over 10% 6 months later. Could be a case they were 9.9 and they ticked up to 10. Could be a case they were 5% and went up to 10%. Or it could be a case, who knows. But the interesting thing is it didn't have a customer who accounted for more than 10% of revenue.
Yeah. Yep. There we go. The 10K that you asked me to pull up, they said no, not a single customer exceeded 10% of the gross receivables as of December 31st, 2022. But for December 31st, 2021, they did have one customer who accounted for 23.1% of the gross receivables.
Oh, they actually broke out exactly how much? Because it just says they exceeded 10%. They don't give the exact amount.
Yeah, they did it for this particular 10K. Yeah, so it's there.
Hmm.
Now again, this isn't necessarily to pound the table and plant your flag on a hill and say this is fraud. Because accounts receivable wasn't necessarily listed as a critical audit matter
Right.
for whatever that's worth. But that being said, though, from an earnings management perspective, just like doing any mental exercises of if you wanted to fudge numbers a little, accounts receivable is one of those that maybe you could goose around a little bit.
So they should have a so here's the thing I would ask too.
Mhm.
What's actually we should have it in here. What is their we've had this with HireQuest, right? With
Yeah,
HireQuest,
yeah.
what is your accounts was it allowance
Oh, the allowance
policy?
for yep. Yeah, that one was really wonky.
Let's see if they say would I have to go to 10K probably to get that?
Probably is my guess, but
It should be listed in here.
yeah.
Okay, company extends non-interest bearing trade credit to its customers versus business, AR.
Mhm.
Oh, actually, shoot, I should go to the most recent one. Sorry.
Yeah.
Is this 10K 2020? Whoops, so we're over here probably where we get the right one. 2023, okay.
Bless you.
Thank you. Okay, allowance. So let's go back to that.
I'm not seeing the policy breakdown. Like the closest I see is that they adhere to the accounting standard update of 2016-13.
Also interesting that their RPOs are going down, but
Yeah. Wait a second. Do they financialize their AR somehow?
I don't. Who?
These guys, Montrose Environmental Group or Environmental Group, DERP. Because why would your 10K reference accounts receivables with the accounting standard update uh, with the subsection or the topic 326 financial instruments dash credit loss, and why would you have financial instruments level 3 where the company considers carry value of cash, cash equivalents, restricted cash, and accounts receivable under
Am I
level
missing this?
3? That's but you don't have it laid out. Voss? I mean, like, all right, not to fully
Well, it
bury
could
the lead.
be. I'm just. It could be that they're saying acquisitions. It's hard to
Mhm.
measure the AR, so that's in a level 3.
Yeah, yeah, and not to bury the lead. A significant controlling interest or a company that's put a lot of interest into this company is Oak Tree.
Oh yeah.
Oh yeah. Shoot, I think like aren't the vast majority of the preferreds, if not all of them, effectively Oak Tree.
Are they really?
I want to say I'm not 100%
Pretty
sure,
fun.
which is one of those things I want to like bring up at some point. Was in the early stages of due diligence, does the nature of who owns what part of the company matter, like where they sit in and the ownership, I guess, or the claims to the company. Because Oak Tree is one of those interesting groups where they could see great, amazing, powerful potential and something that's deep value or very
Hmm.
value. And other times, if you see them sitting where they're higher in the claims,
So,
as opposed to the residual nature of common shareholders, it may
so
terrify you.
they don't really break out what they
Mhm.
how they met, like how they come to allowance for doubtful accounts.
Yeah.
So could be a completely normal, like my company
Mm.
organization, the way that we do it. And like really, it's so funny. The way that you decide this is you just talk and say, like, there's no science to it really.
No, no.
So ours is anything past 90 days because we're in a situation. Most, I think our DSO normally is like 20 days.
Mhm.
Like we normally get paid really quick. So anything past 90 days, we expense 75% of it and allow for it. Everyone can have different things. Some people have like buckets where at 35 days you expense like 3%, or something like that. It's all different. So who knows? But it is interesting that their AR is growing at a faster rate than revenue. So it would be a good question to ask.
Yes.
Why? Okay. So let's go back to this. We did DSO. Um, they talk about the adjusted EBITDA margins, and we kind of looked at this.
Mhm.
Um, yeah, so we did this on the screen, right? The true free cash flow.
Briefly talked about it. Yeah, yeah. The way
Yeah.
how Jehoshaphat, like a couple pages above.
So I I find this all kind of weird. I mean, you're basically saying here are more mature companies.
Hmm.
I haven't looked at these guys. Here are more mature companies that don't have SBC or as high SBC, and we're going to do that to make your free cash flow look a lot like weirder because I guarantee you that. Well, let's see. Because if you're going to do this, you better back out SBC from the adjusted EBITDA number to see how close they are.
Yeah.
But still, it's just a weird, I think, kind of a weird way to look at it. Maybe I'm missing something.
Hmm.
Um, because adjusted EBITDA is trying to say here's our free cash flow amount, and so it's taking out SBC. Free cash flow takes out SBC as well because SBC isn't a truly cash expense, right? So why is that? Let's see. True free cash flows Jehoshaphat Research estimate reflects cat. So they add back in the cat stock-based comp. So that's gonna be really weird here.
Yes.
Huh. That's odd.
Yeah. And we talked about this in the pre live,
Right.
where
So
one of the adjustments was an interesting thing.
yeah, so here's their adjustments to adjusted EBITDA, or how
Mhm.
they get from net loss, which oh yes, Dex, I agree. The name Jehoshaphat Research, I can't like take them seriously, but I guess they're a really serious firm. Um, so here's the thing. They were complaining about
Thanks,
the net
Fabio.
loss. Oh, what's up, Capital Mindset? How are you tonight? Um, so this is a gap net loss from what I can see
Yes.
because it ties their gap net loss on their report.
Hmm.
Um, they talk in here somewhere about like I can't remember. I can't find it where exactly. Oh, is this where? Oh, so they cleaned up the adjusted EBITDA.
Yeah.
So
But
here's adjusted EBITDA. They have normalized bad debt,
mhm.
excess deferred revenue, recurring acquisition expenses discontinued prior to. Why are you including SBC in here? I look at all of these are like, okay, maybe this goes from like 80 to like 70 or 65. Yeah, like
Mhm.
65, 66.
Yep.
Oh, capital mindset. Here's their adjusted EBITDA. It's not that bad.
No.
It's what you would
The
expect.
the only thing that I will somewhat agree with the short sellers on
Mhm.
is, and again, I'll have to double check earnings calls, but given how acquisition happy this company has been,
Right.
if they continue to do it, and being very critical of a word here, and it ends up being a significant number going
Mhm.
forward, then I will harumph and I will agree with the short sellers.
No.
But like even though, like if we look at it right now and look at some of the previous numbers, yeah, it's a number, it's important, but it's not like that critical.
So if you look here, yeah, it's 7 million. And I
Yeah.
would really okay, so we're going to look at their bridge here and they have the numbers here in number 13.
Mhm.
I love that they do this. They put this up publicly. You can just go through and be like, "Oh, this is what they're saying."
Yeah. While you're looking, I will tell the people in chat, like I fully recognize that it's more of a me problem than a company problem. Uh, that I'm not great when it comes to companies that their strategy going forward is acquisition focused. Reason being is because yes, there are cases where it can be a very powerful strategy when done correctly, and not all acquisitions are created the same, especially if it's like additive depending on the integration and the prices paid for acquisition. But at the same time, though, the the markets are littered with a graveyard full of horrible M&A deals.
So so this is such a weird this whole thing on so
Mhm.
Fabio's asking, and Fabio, if you want to hop in, I can send you the invite link, and we can ask these questions and talk through them.
Yeah,
Um,
but yeah,
but
at the same time,
so
materiality matters.
okay, so they do a couple things here that I find really interesting. So what they do, okay, I can't, but I'm shirtless, dude. We prefer that. Come on.
You immediately increase viewership.
Um, no. So they first say true free cash flow. So are they reconciling this to their own adjusted EBITDA? Let me see.
Yeah, I think so. Because the
Okay. I'm gonna
Jehoshaphat Research is true free cash flow with
no, but
quotes.
I'm saying are they reconciling this to Jehoshaphat's research adjusted EBITDA?
Um, seems like it.
I just think I don't know. I kind of think it's weird to be like, oh, we're gonna adjust it because we think your SBC's out, too much. Which, like, yeah, SBC is sure, but like, if you're measuring it to free cash flow, which is what they're trying to do, they're trying to have adjusted EBITDA be a measurement for forward free cash flow, which is why I agree with you with the acquisition stuff.
Mhm.
But
Caveat really implies is important here though, because I agree with you and what you said in the pre-call though. Like it's from a perspective of free cash flow, it's silly to worry about that relative to some other numbers.
where's 9? That's 4,
Yeah.
5, 8, 9. We have shown the process of calculating the underlying true free cash flow, adjusted EBITDA, or very similar metrics such as EBITDA, EBITDA S stock comp is given. We use the last 3 full fiscal years. For example, XPIL's adjusted EBITDA is given it's 2010K. Calculating true free cash flow for all these peers, which all comes very close to traditional free cash flow X stock. So I guess I find it weird so much of their short thesis relies on the fact that they have a lot of stock-based comp, and they don't say it that way.
Yeah.
It's like, oh, the adjusted EBITDA is a lie because they, like everyone else, back out SBC because they're saying everyone else does back it out. Like right here, this is XYL. They're backing out SBC, but these guys have a lot of it. I wouldn't call that like shaky accounting or like anything like that. It's just like they have more SBC. Did they
It's
just have
just
a
the times
Family
we
Guy
live in.
thing in here? I just see.
I thought I saw it too. Yeah, there it is.
Yeah.
Hi, Meg.
Interesting. Obviously, there's like a lot more to this, but I'll send Fabio a link in case he wants to join, but it's completely optional, Fabio.
Yeah.
Hold on,
This
just-
is literally like us doing multiple things all at once because people really wanted early stage or at least some recording evidence of how you do due diligence. And I remain insistent. I don't think that this is great content, but this is
yeah, you can be with camera off.
yeah,
Fabio.
but this is what it kind of looks like is sit in front of a computer, take a look at research, take a look at some boring documents, and listen to some calls at a minimum. Do some collaborative efforts.
So, what they get to next, I think, is fair. Basically, they say we question their cost to cost method,
Mhm.
which was the critical audit matter under revenue rec from the auditors since they
Yes.
acquired CTEH. 2021, I think, is when it started. Before that, it was completely clean. They under this method, they have to estimate the expected cost to complete a contract and recognize revenue for the contract based on the assumed percentage of those expected costs incurred. So basically, do you know what a cost plus contract is? That's what it sounds like these guys do.
No.
It's very simple.
Yeah.
So if you ever have, first of all, if you've ever have someone in construction try to do a cost plus, don't.
Don't do it.
Yeah. So basically, what cost plus is I come to you and say, we're going to charge you a cost plus 10%. And I'll add you to stage.
Oh, whoops. Sorry. Got
So what that does is it incentivizes them to bring on more costs to buy the more expensive cabinets, to do all these things because they're getting the margin on that. It kind of sounds like this is what this is. Hello, Fabio. How are you tonight?
How are you tonight?
I am wonderful.
You
I'm
are
wearing a suit tonight.
you're horrible at this StreamYard stuff. You should have your logo on as your thing.
People just have to know what CM is.
No, okay. Just envision it in their mind.
So to get you caught up on everything, Fabio, short report on this company.
Yes.
The summary of the short report, like here, I'm gonna leave this where I was at. Actually, no, this is where I want to. That's what I want to do.
Yeah.
Pull this up. So some of the things I find okay, like questions. The other things I don't know, and I don't think this is a good time to be shorting a company like this.
Yeah, especially timing wise.
I think the timing is kind of poor. I feel
When
like the time
was this published?
not that long ago. Let me see.
Okay, so it is fairly recent.
Yeah.
And then we're about to have another hurricane right here. I'm gonna have a hurricane party.
Oh, who's invited?
7 days ago.
Oh, 7 days ago. Some friends and some family.
Oh, okay.
Okay.
Buying drinks.
Yeah.
So
this is bad timing.
So it's not going to be like bad where you're at, where you have to like evacuate or anything.
No, even if it was,
Even if it was, fuck it, I'm not leaving.
Fuck it, we
okay,
ball.
leaving.
Fabio has a panic room. Don't worry, people.
Where is it? Okay, so here's like their thing. So they say they're obscuring a decline in organic revenues. They've pulled forward revenues and kind of inflated the revenues by basically boosting accounts receivable and their day sales outstanding going up. They inflate their adjusted EBITDA.
But everybody
The
does.
roll-up strategy is chaotic and it hasn't worked. They have no underlying free cash flow, and they have more financial leverage than it appears. I don't think we'll get through everything tonight. In fact, I'm kind of like towards like we're almost done. We've looked at kind of like the first 2 or 3.
Yep.
I agree. If you're thinking about going long this company right now, which it could be a decent time to maybe do that. I don't know. Honestly, I feel like I'm just gonna like watch and like kind of, but you want to ask the company. So I did like a quick comparison here. Here's like the date. Here's the AR amount, contract assets, which is part of AR, and here's the change year over year, and here's the change year over year in revenue. And I can make it a little bit. Oops.
So it's accelerated.
The AR has vastly outgrown revenue as a percent growth.
Okay. And you talked about them working with government.
Yeah, but government contract hasn't really expanded that much. Like as a percent of
as
revenue.
a percentage, of the mix.
We looked at that.
Mhm.
What
It's
is the
largely hung around
specific
10%.
nature of their service?
What do you mean?
I'm a private company, so I'm not government. I'm talking about the non-government part. What are they doing for me?
So I said that I kind of prefaced this a little bit earlier. I am not an expert at this part. I want to kind of go through like the accounting. So here's what like they say they do, right?
Mhm.
Environmental assessments, environmental emergency response, toxicology consulting, environmental audits and permitting, some kind of advisory services.
Yeah.
Then they have measurement analysis, which is probably, you go in and you're poking the ground to see what's in it, like how toxic is it. They're actually then the lab that's doing it, and then they consult on how to fix
it.
everything. They have a large water treatment segment too.
Yeah.
It seemed like that was fairly large.
Yep.
So like if I go through this, third-party study conducted. Okay. So just like environmental like solutions to make sure you're not dumping toxic waste on your property, that you're more efficient. Like it's kind of ESG, but also like I wouldn't say like ESG in a necessarily super negative way that some people think. Like I'm thinking more like making sure that you don't get fined by your city or your local government because you're dumping, toxic waste. You're not another Duke Energy, for those that know that reference.
So are more of their payments in net 60? Or they look like they're net 90?
No, I haven't been able to like go through and calculate exactly, but like to me it looks mostly like because they don't break it out. But to me it does look like their DSO has been going up pretty, quite a bit, obviously because revenue or AR is going up faster than revenue.
What kind of clients?
Well, here's the revenue by end market, right? So we were looking at this earlier. So here's 2023.
Oh, government's 11%.
Yep.
Yeah.
So did I close out the other ones?
Possibly, but like
no.
By and large. Oh, okay.
So here's 2021.
Yep.
Now it says 18.4% here, but right here it says 90-10% revenue split. So you could try to look at the different industries, and maybe there's an industry that has it more, but like
they also made an acquisition at that time.
2022
numbers.
Government's 11%. Manufacturing, it looks like they've shifted from here. Let me pull this over here so we can just do like a quick. So here's manufacturing's gone down, transportation's gone up. Do you think transportation is like Fed government? Or do you think it's just transportation companies?
I want to say transportation companies because
right.
Because they already have a layout breakout for government, and they've had government breakout for some time.
Because transportation isn't even a subsegment here.
Yeah.
In 2022. So it's Amazon, and Amazon's like, yeah, buddy, we're paying you net 365. Or
think of the power.
I guess I feel like that's a question for IR. One thing I did say though, Fabio, that I found interesting. I pointed this out in the 10K. So they have some client who's either not paying or has longer AR terms. So here, this is the most recent 10Q, actually. I'm sorry. So the company had 1 and 0 customer that exceeded 10% of its gross receivables as of June 30, 2024 and December 31, 2023. Which means there's someone whose percentage of AR as part of the pie is growing. And they aren't writing that off. So, and they say no customer is more than 10% of revs.
Yeah, and if you look at it from
I'm sorry. No. Yeah, for the 6 months ended June 30, no customer during the 3 and 6 months ended June 30, 2023. Okay, yeah. So one customer doesn't account for more than 10% of revenue, but they account for more than 10% of receivables.
if you also God.
Either they got very nice terms or they're not paying.
Yeah. And it's a weird case also though where the previous 10Ks have laid out where there's lumpiness in that 10% or 10% plus, whoever that is, of ARs, and you will also see periods of bad debt expense hitting, and then all of a sudden bad debt expense being recovered. So there is the weird lumpiness to allowances and bad debt expense and recovery. So it is kind of curious. Now, granted, though, like this is number wise, is it big a deal?
I'll go to the one part of like the short report that I found kind of like bullshit, or like kind of like I don't know why you're looking so closely at this. So they go through this whole thing about how like if you look at it, their true free cash flow is like worse than everyone else's, and basically they're going through this whole thing to say these guys have a lot of SBC. Like they could have saved 20 pages and just said there's a lot of SBC as a percentage of like that's all it is. Because like, but what they're doing is they're taking, which this is moronic in my opinion, but like they're smart people. I get what they're trying to show. Not really, but they're saying true free cash flow is like free cash flow and then taking out stock and then also subtracting out stock-based comp and preferred stock dividends. So like I kind of get the preferred stock dividends because you're trying to show like, hey, here's like actual free cash flow to common stockholders, but pulling out stock-based comp out of a free cash flow doesn't make any sense to me. And then they go down here and basically say, like, I'll show you. They do that bridge. Where is the bridge?
Welcome to the Greater Capital Mindset lore, where bridges are always talked about, one way or another.
I will say it does challenge me for a long idea.
What for this?
I don't really find it.
If it's a lot of SBC.
Yeah, because it is. Yeah, like as much as Andrew is grumpy over SBC being lumped in under free cash flow, he Andrew and everyone here knows like free SBC is actual expense for equity owners.
Most
non-cash
expenses.
My issue is how they're kind of like trying to show it as kind of like hidden and malicious. Maybe they're not really. Maybe I'm reading it that way, and they're not really trying to present it that way. But they're like, oh, that's like, it's not real free cash or like adjusted EBITDA or free cash flow. And I'm like, yeah, and I agree with you, Fabio. Like, not super attractive, but at the same time, so here's their like they're bridging. Here's the company's stated adjusted EBITDA to like their cleaned up adjusted EBITDA. One of the things is they're like taking out 20.6 million of SBC because it's like more than the average SBC. And then they're like doing some other adjustments. I agree with this one, the acquisition expenses. Realistically though, I mean like, okay, you go from 81 million to 65 million or 66.
Yeah, but is it that material?
I mean like that's material I'd say, but like,
but like,
and also these items I don't know too much about. It's basically them saying like, we don't believe your sales numbers. So I think like if you're considering this to be a long, there's like maybe like email IR and like ask, why is your DSO going up? What's your allowance policy? And like, why is your allowance so low? And like, why has your AR been growing at a much faster rate than revenue? I don't know. I think, what was the other thing? Yeah, so DSO growth, right?
Yep.
What's the reason for that? Like, why is there now a customer who's not 10% revenue but is 10% of receivables? What were the other ones I had? I talked about them throughout this. Let me go back to because I can remember if I.
Yeah.
Oh yeah, so pulled forward revenues. I mean, you're not gonna have underlying free cash flow to shareholders if you have to pay. I mean, if you're negative free cash flow, so I think that's kind of. Oh, the SBC. Why is the SBC so high, and do you have a plan to take that down? So, like, do you have a plan? Like, why is your SBC so high, and do you have a plan to take it down? What's up with your AR growth in both contract assets and like just straight AR?
Is there any abnormality in the expenses for, does it look like their comp might be lower than their competitors or peers? What I'm getting at is, are they paying a lot of their employees in just SBC and foregoing, cash salary, but their competitors?
No.
So like basically, are their margins just way worse in reality?
Well, that's what I'm assuming they're doing because their cash flow isn't as solid as competitors, right? So so here's
why not go long one of those competitors that do the same thing in this environment?
Go along one of the competitors.
Yeah, because like as a trade, and this seems more like I'm not necessarily short, but boy, because I think it could move on just the belief that they're going to get a lot more business.
Well, these guys, they better have some free cash flow coming in, or is they're going to have to do another like equity raise or debt raise. They've bought a lot of stuff though. Look at that goodwill.
Yeah, it's a sizable chunk of.
It's a lot of goodwill, but like maybe they're not they're just getting these acquisitions in, so the revenue hasn't really kicked in yet because the revenue growth hasn't been that high either.
So we have Clean Harbors.
They have some competitors in the short report you can look at.
Yep.
You want me to give them to you?
Yeah.
Hold on.
It's not fairness to this company though. It's not a fair one-to-one necessarily.
So these are some larger players, but you have TTEK, T-Tech,
Okay.
ACM,
Okay.
XYL.
Okay. I just took a screenshot.
Okay, you got it.
Yeah, I just sent it again.
Perfect. So, yeah, I wouldn't be interested in this as a long, and I don't think I'd be interested in it as a short either, because you could. I mean, they're already down. Like, it's just an interesting time for a short report. Like, they did it a week ago, so it's 10/6. So, like, they did it last Friday. I mean, I guess it has dropped 17% since then, so maybe on the short report announcement.
Yeah.
And it seems to be recovering a little bit now. But, like, the real time the short was up here. You know, if you
Anywhere
saw
around there. Yeah.
Yeah. Even here would have been. Well,
Well, don't you think they were short already and they just released the report now?
Probably.
Try to drive it just a little bit lower.
Oh, yeah.
Their exit.
Yeah, maybe I'm cynical, but I tend to. The kicker though with all this though is like, we do have immediate tailwinds, assuming that if what management says is true, that like emergency related events tend to be tailwinds for them. But I don't see SBC or any sort of dilution necessarily slowing down, and how much that undercuts it, I'm not sure. And and again, fairness to this company though, like relative to the peers that Jehoshaphat references, this is really small and really relatively early stages compared to that peer grouping. Because much like how sadly you missed this, Fabio, if you look at net income, cash flow, and cash flow from ops and SBC, using ticker at least, they all show a similar pattern of like relatively early stages as a publicly traded stock, ugly numbers from like operations, dilution, and net income, but they inflect and then they do well once they achieve size. Whereas this one is definitely not there yet. We're talking a peer group, quote unquote peer group of over $10 billion market cap, whereas this one is not even 1 billion. It's roughly a little over 3/4 of the way to $1 billion. So maybe market cap and size matters. Maybe there's a scale component or a size element.
Networking to get the contracts.
Yeah.
Tech. Yeah, all these other guys have been doing fairly well.
At least the ones that we looked at, which was only 2 of the 4, I want to say.
Tetra Tech is a monster.
Yeah.
Wow.
Yeah. Maybe it's just the case of winners keep on winning.
I mean, it could be some interesting stuff to actually look at. As long as
that is a fair point. Because like relative to market cap and all that, if they are diluting, it doesn't seem to be too concerning relative to size.
I guess we can talk about this one some of the time in the future. There's one that's a weird co that I've come across by accident, but looks interesting. Another winner keep on winning.
Who is it?
Clean House or Clean Harbors.
Do they do well with their Fair Harbor disclosures?
Cleaning harbors.
Huh. Interesting.
Yeah.
Well, that's that. It says related to this is Montrose Environmental.
Curious.
Not sure because I don't think they do the exact same thing. They do some disposal though of hazardous waste.
Yeah, I'd have to study more like what exactly Montrose does to give you a better answer than that. I just want to look more at the accounting things that were being.
Yeah.
Because I mean,
as far as I can tell, like the group does a bunch of things from water testing to analyzing and testing methane leaks, etc. So much like what you've covered, it seems like they do a fairly wide and integrated amount of goods and services on that, to include laboratory testing.
Yeah, it's
so there you have it, live chat. This is exhilarating content of what real life due diligence looks like, early stages. Like the only thing that you missed out is what, like us listening to an earnings call.
That and us going through some other stuff like earlier, but
and like here's I will posit this question. I think I can weasel this one in. When it comes to like an investor base, how important or where would you put that in consideration during due diligence? Because I referenced how it appears that this company, Oaktree, is a significant force, and that last I saw, or at least very early stages, it appears that they are just sitting on preferred shares with this company. Does that change anything for you guys?
The thing about Oaktree versus a common equity investor is Oaktree is asking themselves, will this go to zero?
Mhm.
I'm asking, will it go up?
Fair.
So
Will it go up? Will it go down? Long, short.
yeah.
Um,
So
'cause-
I don't take a whole lot of, you know, in, I'm not saying anything against Oaktree. I just don't think Oaktree should be a signal for really anyone. I don't know if Fabio has a different opinion.
For finding companies, what you think about this company?
No, so
mean-
he was saying Oaktree is heavily involved in this company. Does that mean anything?
No,
Yeah.
not at all. You
Okay.
you said it already perfectly. Oaktree's like, will they die? Will I lose my money?
Yeah.
And we're focused on the upside.
Yeah. My
of the
one
equity.
thing. My one thing is that, like, as a person who has had curiosity with like deep value investing,
Mhm.
like the whole price to book is really cool. Uh, if I saw Oaktree, and I were holding commons, that would terrify me in some
Mhm.
cases. Yeah, because
Oh, because
Wait,
you're
wait,
saying
wait.
like
What are
they're
you
saying they're
talking about?
distressed.
I look for companies that are. I buy the stocks of companies that are currently engaged in discussions to sell a business unit to Oaktree all the time.
yeah, so like if
Supposedly,
yeah, like
allegedly.
yeah, so
Yeah,
there.
it's a good sign.
Yeah, not saying it's necessarily for everyone, but if you're of that mindset, maybe consider where you sit on the capital structure, especially
Ah,
if some people have a renowned reputation. So that's what I'm getting at. Even though, like in this case, my question got shot down. In some cases, that really matters.
a mindset, a
A
capital
capital
mindset.
Yeah, yeah, yeah. Fabio, what's it like not hearing beeps from fire alarms?
Oh, it's finally I can hear myself think. It was resolved at like what? When did I leave you guys? Like 2 a.m.
Yeah, ish.
Dude, I'm exhausted today. I did not sleep well.
Beep.
Yeah,
Wait, I thought you said they went out to the store to game.
they did. No, they went out at like 1 a.m. because it started right when we were about to go to bed, and then it went beep. Like, do you have any batteries? Nope. So then I was like, we can't sleep.
I'm not going to tell you what I do in those cases. I don't think I'm supposed to say this stuff on YouTube for my house insurance. But I have a little thing that I do, and then the next morning I get it figured out.
Yeah.
It's pretty
So-
easy to take.
Huh?
Nothing.
What was that?
It's
Oh!
pretty easy to take them off so that you can get your replacement that's got a battery in it and it's fully ready to go and put it. That's in the garage and put it in.
I have a fun, like really silly or stupid question for everyone here.
Mhm.
So we all are very much aware of diluted and undiluted EPS.
Mhm.
If you could envision a sort of diluted, undiluted free cash flow per share, what would it look like? Because you don't want to double count,
Wait,
but at the
diluted
same
versus
time,
non-diluted?
yeah.
What do you mean?
Well, like how for EPS from a net income perspective,
Mhm.
you have two choices. You can take the undiluted or the diluted numbers.
Sure.
Yeah. How would you envision that for free cash flow? Because like you don't want to double count like any sort of share dilution.
Well, wouldn't you be doing the diluted share count in that period that's already been increased by the prior period's dilution, and then just the cash flow of that period? But you're not going to take into account the I see what you're.
Yeah.
I
It's a
don't
bit of
see
a
what
conundrum.
I don't see what you're getting at. So what's the issue? Why can't you just use the diluted count, divide that by free cash flow, and you get free cash flow per share? Or take free cash flow divided by diluted account.
I also don't see why that would be an issue now.
Oh, okay. Alrighty. All right. It's a little late, so I just
No,
wanted
no,
to
no.
see if I was
I'm
double
not saying
counting.
it's.
Yeah.
No, I don't think it's. I think it's totally fine to do it that way. I would just take free cash flow divided by fully diluted EPS, whatever that is,
Mm.
and that's your. I always use fully diluted for whatever
Yeah.
it's worth.
Yeah. Because
My issue with Vistry, because they still didn't answer my questions.
yeah, so that's just wanted to throw that one out there because some people might be like, but dilution is a real expense, just a non-cash one.
No, but you're gonna see that dilution hit your. So you're asking how do you count for it as far as like expensing the dilution into the free cash flow statement?
If someone were to want to do it, but trying not to double count, because
You would
like,
just do free cash flow for sure.
yeah,
Because because I know what you're saying is like you're trying to say simultaneously
hmm
dilution's a real expense, but it's not a real cash expense.
yeah,
So how do I properly account for that? I don't
Yeah.
think you do. I think you just look at the financial statements in their entirety
hmm
and know free cash flow per share is this, and the dilution that happens will impact free cash flow. But then you look at the P&L and you have a net loss or net gain, and the SBC directly impacts that. And you do get to see on the cash flow statement, what the SBC was.
Yeah. Yep.
And like, you don't have, because you can do that and start playing with it. Like a lot of times I look at some company, I'm like, dang, look at this SBC. It's insane. And even though it's not a cash flow expense, I'm like, well, all their cash flow is just SBC.
It's just one of those things that I wanted to throw out there as a conceptual topic because respectable people in the past have been called out of, or at least asked, aren't you double counting SVC when you do your models? Some people have models and may want to consider that. Just throwing that out there. That's all. So
I'd have to look at why people think that's double counting, but
I guess it again, order of operations matters where you do it and how you do it. Anyone have anything else on this, or anyone want to hype anything up as far as future stuff, or shill a YouTube channel, Discord?
Anything coming up soon? I might win a fantasy game. It's been a while. It's been like 2 weeks since I won my fantasy game. So,
yay! Bullish Andrew's fantasy team.
With that being said, the one person that has to start for the person I'm playing is probably going to go off now for like 50 points. I'll lose.
Oof.
You want to bet a Chipotle bowl?
Dude, guess who my highest scoring unit right now is? The Vikings D. And what I bet a Chipotle bowl that they will or won't have that happen.
Won't.
So you're betting that Kareem Hunt will not get 50 points.
Specifically that person?
Well, that's the person I'm playing against has to play still.
Oh.
Is it? Do they have to score above, or they just don't have to score 50?
No. I mean, I'm up right now by 13 points. I have Alvin Kamara playing. He has Kareem Hunt.
I'm scared of this bet now because I have no idea how this point system works.
Oh, Kamara,
it depends on the league.
Way better player than Kamara's the number one running back in the league, I think, right now. Right?
Yeah.
By point.
Yeah. He has been going off.
Yeah, but you never know. Like he could just tear his ACL tomorrow. And it's like, oops, well. Like I had G. Rice, and he was doing awesome. And then Patrick Mahomes, he's a wide receiver for the Kansas City Chiefs. The quarterback, Patrick Mahomes, throws an interception. And Rasheed Rice is like trying to chase the guy down. And, the quarterback does like a pussy quarterback tackle where they they fall kind of to try to hit the guy's knees.
Mm-hmm.
Hits his own player's knees and tears his ACL.
Oh.
Yeah.
I hate when that happens.
It's so sad.
Especially
when he's on my team.
Sports betting is hard. The true risk-free rate would be just contraing whatever sports bets I may have.
I have to
Which I
disagree
don't.
with you, Bacon. Have you heard of Kelly OG? You can sign up for her services.
Oh, wait, is she still around?
She around in some form or another,
Oh,
probably.
okay. Fair.
Selling courses on sports betting.
Is she a sports betting?
Oh yeah, that was part of her thing.
No, dear God.
Cole's video, that's like an hour long, is still his magnum opus. Like he's never done a video that good ever again. It's such a good video. Like I told him, like if you did videos like that, he would be big on YouTube. But no,
I don't know.
Well,
I
he's-
really like
she
his.
is
his
not
pitch.
just kind of. She has 354,000 subscribers. Oh, she's getting no views compared to her subs though.
Yeah, and I really liked Cole's Yeti analysis or Yeti pitch.
and
He
didn't it
did
go
on
up?
Strongman. I'm not sure,
I
but
think
like
it went up.
it was very funny though. Like
Like,
it was
Fabio.
funny.
She has 354,000 subs, and her lives get like somewhere between 5 to 10x the views Capital Mindset lives do. Not even like 4 to 8 times
She has 4 to 8 times more views on her lives.
than us, and she has 354,000 subs.
Damn.
So she gets like the last live got 9.6 thousand views.
Yeah, thank you, Dutch. Thank you, Dex. It was a great pitch. It was in fact a great pitch.
You guys got me now exploring all these environmental codes that I've never looked into, and I'm like, where have you been all my life?
Right?
Yeah,
It's wonderful. There's so many companies out there to.
They're just
yeah.
swindling the government. I love this. No, like these ones. I'm looking at.
So they're swindling our tax dollars. Lovely.
Yeah. Well, I mean, like it also does depend on their structure because like you could like just envision this being any number of like revenue structures. Like granted, sure you're still sitting on that 90-day ish, DSO, which is scary, but if you're big enough.
Oh,
it
this
can
gun
work
got
out.
acquired. Damn it. No.
Well, I think what we'll do is end the stream here. Probably in the Discord, we can probably chat.
Thank you guys for having me. Next time, I swear, if you invite me on, I'll have my shirt on, more energy. I drove through the rain for 2.5 hours.
Nah, it's all good. Just glad you got back home safe. You thinking, Andrew, that we might revisit this one, or no?
Potentially.
Okay, that's fair. Because we all know that we're sitting on a whole bunch of ideas for this side project.
Oh man, Ryan Williams just moved to a membership model. Nice.
Yep. Everybody's doing it. If we had a membership model, I would start launching songs.
I mean, that's fine. I don't know if he.
No one wants to hear me sing. Alrighty, on that note, with songs, Country Roads, take us home.
Oh, I thought you were gonna sing Fuhat's favorite song.
No.
Cause baby,
Dear God,
gonna be the one that saves me.
save me, chat.
All right, I'll see you guys.
All right, thanks for having us on. Thanks for being here.
That was amazing.
Yep.
I live for that.